One misconception that everyone has is not all 401ks are created equal. It is a vast tax code. It is a lot of gray area. And when you go the DIY route, or you go to the one that is at the top of Google, or however that works, the biggest company you can find,
Yeah.
their protocol is based on their business model, and their design is based on how they want to scale. They keep it inside of a very narrow scope. They do not think outside the box. So not all 401ks are created equal. And number two is do your research. Do your research. This is not an easy Googleable scenario. A lot of the things that we talk about today are not something you're going to be able to find very easily out there on the internet, or it's you have to have conversations. When you're a business owner, it's that building that team of people you can trust. And it's all about having conversations and getting the information you need in order to be able to make those decisions, and do it early.
Welcome to another episode of the Business 101 podcast, where we unpack the real stories, strategies, and stumbles behind building and growing successful businesses. Today's guest, Matt Ruttenberg, is on a mission to blow up everything you think you know about 401ks. After 20 plus years designing retirement plans for entrepreneurs, Matt realized most business owners are leaving six figures on the table simply because no one ever showed them how to turn their case into a tool for themselves. He's not a financial advisor. He's a strategist who works with founders, real estate investors, and CEOs to use the tax code legally, stack retirement plans, and unlock serious cash flow. If you've ever thought 401ks were boring or just for employees, this conversation might change how you see your business and your money. That said, let's welcome Matt Ruttenberg to the show. Good
Thank
to have
you
you
for
here, Matt.
having me on. Appreciate it.
Yeah. It's my pleasure to have you on. I guess a good place to start would be to first try to understand your money conversation, your business story. How did you come to this place where you're helping entrepreneurs and founders to figure out how to leverage 401ks? What was the journey like?
Yeah, basically, over 20 years, I'm a third generation
Yeah.
financial expert, father, grandfather, and I started in, individual investing and working with individuals in the B2C markets. And over time, I I started to be more attracted to working with the entrepreneurs because I own my own business. I wanted to work with my colleagues and my peers. And I was more of a generalist. I was the one kind of being the quarterback, if you will, and bringing in the specialists. But as I started working with the entrepreneurs and working in the retirement plan, like the 401k defined benefit plan space, I ended up being that specialist and really studying it and focusing on it. And then over the last maybe 10 years, I ended up selling my individual clients off, that part of my business off, and only focusing and merging my business with LifeInc Retirement Services, where I'm at now, and becoming an absolute specialist. So I get to work with the financial advisors. I get to work with the CPAs, the tax strategists, the entrepreneurs, and be a part of the team, and bring something very valuable to the table, and the big cost tax savings tool. And that's where I've kind of landed now over 20 years of working on it. And it's been a fantastic journey so far.
Interesting. And Matt, what was the early moment, right, when you saw how broken and underutilized the system was for an entrepreneur? How did you get to that place when you realized, it looks like the odds are stacked against entrepreneurs. Let me try and fix this.
Yeah, that was a long time ago. If you really look at it, into the 10K is, a tax code, right? If you look at the IRS website on what is the 401k tax code, or you talk to a CPA or an accountant, what is it for? It's all about how much can you put into it.
Hmm.
The design itself has a lot of gray area. So understanding that 23,500 is not the only dollar amount that you can put into it, and understanding that there's a focus, and understanding that the focus is the business owner. The tax
Hmm.
code is built for the owner, the ownership, the company itself. And it's just that you have to take care of a minimal amount for your employees. The IRS says, okay, checked off that box. You've taken care of the bare minimum for them. Now the owner can go all in. And, when you design these things, and you'll see, you know, owners putting in $300,000, the employees are getting 3%. The efficiency rating is over 97% of where the
Mm,
owner's keeping most of the money, whereas the vast majority of people out there, and I'm talking everybody, CPAs, everybody thinks that it's mostly an employee benefit and a minor tax savings tool. And in reality, it's a massive 6-digit tax savings tool when you start building these stacks. You build retirement plan stacks. That's actually what it is. It's an upside down. Imagine an upside down 3-tiered wedding cake for anyone who's listening, or an upside down pyramid. The smallest layer is on the bottom, and you just keep adding layers and layers on top
yeah,
of it in order to be able to create this massive tax savings tool.
interesting. I want you to explain how, 401k is a tax saving tool.
Yeah. When you are contributing into the plan, right? It's sponsored by your company. There's multiple ways to get the money into it. First and foremost, it's you as an employee of your own company are allowed to put in the bottom layer, basically. As you contribute into it, the IRS is looking at your overall tax bill and saying, okay, let's say you made $100,000, you put in $20,000 into the plan. I'm going to tax you on $80,000. And then we're going to defer that down the road. That's you as an employee of your own company. Then your profits of your company, whether it's 100,000, whether it's 1 million, whether it's $2 million. What we're trying to do there is take money out of that profit above and beyond what you've already put in, the 23,000, and use it as an employer contribution. And when you're doing that, you're taking all the money off of the top tax code tier, whatever your top margin is. So if you're in the 37% federal tax margin, every dollar you put in, you get to keep 37 cents in taxes and hold on to it. And then you can defer it for future use. Big tool to help you grow your business and reinvest it in your business or buy other businesses or franchises or whatever your business model is. It's a very, very powerful 40 cents on the dollar tool to be able to save.
Interesting, but when you compare the K, which is essentially the IRA, right, with the Roth IRA that allows you to pay taxes now and then save on taxes in the future, right? Wouldn't you argue that the Roth IRA might be a better alternative to the 401k?
So the IRA is the individual version of the 401k, right? The
Okay.
401k is a employee or company sponsored plan, which has tremendous higher amounts of contribution availability. There are a lot of strategies around the 401k. So the Roth is, there's a Roth IRA, there's a Roth 401k as well. So 23,500. There's something called a mega backdoor Roth conversion where you're able to get $70,000 Roth every single year. And the Roth is absolutely a powerful tool on its own. So you pay your taxes instead of the tax deferral, like we just talked about,
Yeah.
the money you put in goes in after you pay your taxes. So you put in $10,000, you pay those taxes on the $10,000, but the entire growth of that investment over time
It's
is
tax free.
completely tax free, right?
Yeah.
And what happens there is you end up paying a huge percentage less. And if you run the numbers, you could pay 10 times more money in the pre-tax than you do in the Roth or
Mm,
more, depending on how much it grows. But the concept, it's split. Some of the most successful business owners I talk to are split 50-50 on do I do Roth or am I looking
mm,
for the tax break in the current year,
okay.
right? Do I
Okay.
want the taxes now or later? And the difference is if you go pre-tax, you're saving that money of 37% or whatever the tax bracket is. When you do that, you invest that difference. So instead of investing a dollar, you're investing $1.37 to allow you to have that even further growth. Yes, you are going to pay taxes on that in the future, but it's also going to compound and grow to potentially more depending on
Mm,
how you invest. It's a 50-50. It's interesting how the most successful entrepreneurs I talk to are split right down the middle on do I do Roth or do I do pre-tax?
mm. Okay, that makes sense to me. What you're essentially saying is that even though with the 401k you get to put money in pre-tax, and then in the future you're going to pay taxes on both the capital and the growth. Because you've
Mhm.
invested the growth from the beginning and has compounded, you might end up having a bigger, leftover even after paying taxes and all of that.
Right.
That makes sense. from an this is, I believe, is more from a founder business owner perspective, right? From an employee perspective, do you still think this is a good strategy?
That's again a very good question because it's a lot of it depends on your current situation. But really I love Roth. And I think it's because um when an employee of the company invests into the Roth, it's like, I'm going to pay my taxes now and everything is going to be cheaper in the future. And because we know where the tax brackets are right now, we're historically at the lowest point in taxes right now. There's a book called The Power of Zero that explains like what's the goal? How do we get our taxes down to zero in retirement? And there's a lot of strategies inside that book. It's all about, if you do pre-tax, that's great because you have a lot more potential with pre-tax as long as you invest your tax savings. You have to invest the tax savings. If you don't use that money for buying other businesses or investing it on its own, then you're not going to end up with the same amount. You're going to end up with less because you're spending that tax savings. If you spend the tax savings, then it's not as powerful as a tool. So then that's
True.
that's where the Roth comes into play, as kind of like keep holding them accountable to make sure that, yeah, I'll pay it now and then have a better future of tax-free retirement.
That makes sense. That makes sense. Okay, so you've historically said that a well-designed okay can lower a founder's or an entrepreneur's tax bill by up to six figures, right? Can you walk through how that actually works in practice?
Yeah, it's going back to that upside down, the retirement plan stack. The bottom layer is the 401k. Then you start adding profit sharing on top of that, and then you add defined benefit plans. A defined benefit plan is a extremely um, has extremely high level contribution limits, and it's age based. So the older you are, the more you can put into it. And it peaks around, when you're looking at all three layers together, you can put in around 50,000 per year. We have strategies that allow you to get more into it based on some fair market value situations, the way it's calculated and things like that. So about 350 is the peak where you can get into that. And this is defined benefit plan is kind of like an old school pension, right? So the Fords, the GMs, the companies that used to have all these pensions, they're gone. They're not around anymore. These pensions are traditionally not around for these big companies, but for smaller companies, they are still here. However, we're not building the traditional pension where you're promising this future paycheck when you retire. It's called a cash balance plan, and it's a more casual version of the pension plan. It's calculated the same way, but there's an actual physical balance. And when you're done contributing, you turn it off and you roll it into your okay, and then you're done. But it's calculated the same way and you get the same contribution limits. And that's what allows you to build a much higher level contribution amount. And when you're building this retirement plan stack,
Yeah.
every layer is designed a specific way to maximize the layer above it. There's a lot of two kinds of plans out there. There's a boilerplate version, which is kind of like going to LegalZoom if you need a legal document,
Yeah.
downloading the page and just plugging your name in, and that's it. That's the very boilerplate design.
Yeah.
Then there's the custom version, which is called non-prototype. And that's like going to the attorney, having it designed your document exactly the way you need it, because we are building a legal document when we build these things. And it's built for your business, it's built for your situation, your goals. And then you can amend it however you need to as your business evolves, because businesses evolve daily, basically. And if they don't evolve daily, then that might be okay. But realistically, when you have employees and you have these higher level profits, you need to be able to pivot, and you got to be able to
Yeah.
pivot for your benefit, not all the other companies that go along with that same boilerplate design.
Yeah. Okay. Okay. That makes sense. And let's try to make it a bit more practical now, right, Matt? Let's say I'm a founder and I make $700K in profit a year. What are some actual moves I could make right now using your approach to maximize my, savings and things like that?
Yeah, and that's let me walk you down kind of like the process of how we. It's a vast world, retirement plan design. There's a lot of versions and a lot of options, and trying to nail it down to which one are we using is a conversation. It's a journey to get to that point. So the first thing we do, we always ask two questions. Number one is, what is Why are you here? What's the purpose of you being here? What's your goal? What's your priority? What's your motivation to building this plan? And a lot of people don't even realize this full potential as I'm talking to them or as my team is talking to them. So we have to kind of unlock what we're trying to do. And it's really a multiple choice question. Is this for you or is this for your employees? And if it's for you, we say, okay, this is tax savings. You're trying to diversify your investments, whatever you're trying to do there. But if it's for your employees because you're trying to recruit and retain and grow your business further, then we're going to have a different design there. And then the final question is, how much do you as the owner want to contribute? And that's kind of a loaded question, but it gets us to the point of how high does this stack go? How high do we need to build and design the stack for you? And the question, again, it could be multiple choice. Is it nothing because you want to reinvest your money, your dollars into the plan? Or is it as much as humanly possible because I've already got the profits, I've got the income coming in? And if you're doing 500,000, it's probably, I want as much as I can in this thing because I already have enough income to pay my living expenses. Now I want to put more into it. But the goal is to not give it across the board to all your employees. The goal is to give it to the owner. So we're going to build a 401k. We're going to design it a certain way so we can maximize profit sharing to the owner, but minimize it to the employees. And then we're going to add the defined benefit plan on top. And then we can even do more versions within that defined benefit plan to maximize it even further to get it higher and higher. It's called a split funded defined benefit plan. That's how you would end up designing the full stack. For someone, 500,000 is a really good earmark for if you have that profit. So you pay yourself the salary, $100,000, and you still have a profit of, I'd say, 3 to 500 and up. That's when you really start adding on to these stacks, and that's when the potential is there to save a lot of money.
Interesting. Is there a reason why this approach has an employer focus? Why can't it be win-win for both employers and employees? Because some of the
Yeah.
listeners are going to be employees and trying to also maximize retirement benefits, 401ks, Roth IRAs, and things like that.
Yeah. Well, when you're building the stack, every layer gives something to the employees. It gives something to them. So the bottom layer is the match. That's the match that when we go to work and we log in, we know there's a match coming from our employer. That's step one. But the
Okay.
profit sharing is also going to come with some benefits to the employee as well. But it's going to be more based on the tenure of your company. So if it's going to be, it's more of a retention tool. So there's going to be a vesting schedule all the way up to 6 years. So the longer you're with your company, the more you'll get out of that. And then the same with the defined benefit plan. You're going to get something very similar. And then that when you exit the company or retire, you'll be able to load that defined benefit plan back into your 401k. So the employees are getting something along the way, just with the owner, but we're able to target the owner. Actually, we can target individual employees as well. So if there's a team of mission critical employees that are helping run this company and very, very
Yeah.
crucial part of the company, we are able to target those people as well and focus on them instead of focusing on everybody.
Yeah. Yeah. That makes sense. That makes sense. Matt, I've spoken to a number of business owners who they don't even pay themselves, a defined monthly salary. It's more so, oh, I need some money. I'm gonna take a tiny bit out. They pay everyone else, but themselves they're like, oh, I'm gonna make some money when I sell in the future, or let me just keep reinvesting the money into the business and things like that. So they don't
Yeah.
even pay themselves a defined salary, talk much less of setting up a 401k for themselves, right? Can you talk through some of the things they're getting wrong and how they should go about starting out, registering for 401k and beginning to set themselves up for success in the retirement?
Yeah, a couple things. First, now let's start about having the 4K. So there are 43 states. They're in progress. They've passed the bill or they're trying to pass a bill of a state mandate of opening up a 401k if you have, or a retirement plan in general, if you have employees. So for example, Illinois, Maryland, California, Colorado, those are ones that have one now. So if you have, for example, 5 employees or up, you have to have some sort of plan in place. California is going all the way down to one. If you have one employee now this year in 2020, actually, I think it was 2024, maybe 2025, they have to have it in place. Uh, it doesn't have to be a 401k. There's different things you can do. There's a state version of it, which is basically bag of IRAs for
Yeah.
the company. They're not very good, but they're there. They're free for the employer if you want to do something. Uh, but when it comes to the business owner side of it, it's all about how their entity's structured, or
Yep.
how is their entity structured. If they're an S corporation, if they're filing as an S corporation and you aren't taking a salary, there is no money to calculate. There's nothing to offset because distributions, like you were mentioning, that you're supposed to give yourself a salary, and then the distributions are where it comes after that,
Yep.
or dividends to help save your FICA taxes. But when it comes to the S corporation, if you don't give yourself a W-2 salary, you can't contribute into a plan at all. You cannot. But it sounds like maybe those people you're talking about, they don't care anyway. So they might want to open up. This is a very interesting conversation I had with somebody last year from Illinois, and the state mandate was driving this top conversation. So going back to those two questions I had, what's the purpose of our conversation today? It's like, I want to open up a 401k plan. Illinois' version of what I need to offer is awful. So I want to do a 401k. I want to give my employees a match because I appreciate them and I want to take care of them. I said, great, perfect, great reason to do it. So the second question is, how much do you want to put into it?
Okay.
And he said nothing. And like, okay, nothing. Are you reinvesting into the business? Are you in growth mode? What are we doing here? And he's like, no, I just don't like the traditional investments inside of the plan. I said, I understand. Having a menu of mutual funds in there are not always the greatest thing, especially for entrepreneurs who like to build income producing, like the whole rich dad, poor dad book, right? They're buying
Yeah.
income producing assets.
Assets. Yeah.
And so we were able to remove him from eligibility and only offer it to the employees. But as a side note, within that, there's a lot of business owners with that same mindset. I want to buy businesses. I want to buy real estate. I want to go above and beyond the menu that is created for my employees. Okay. And I'm talking 401k, profit sharing, defined benefit plan. That's a code. That's just how we get the money in and save taxes and how it's taxed. That's it. It does not define the investments inside of it. So inside of a plan, you are able to invest in real estate, cryptocurrency.
Yep.
You can become a private lender. You can do all these things. It's just when you have employees, generally there's going to be to keep them to give them less options to protect themselves from making bad decisions, basically.
Yeah.
But you are able to self-direct those dollars. You can even invest in your own company. It's called a Rob's. Okay. So if you have a big amount of money if you're from your old day job and you're starting your own business, you can use that money to buy shares of your new business, to invest in your new business that you just created. It's called a Rob's 401k. The umbrella is the plan design. That upside down 3-tiered wedding cake is the plan design and how we get money into it and how it's taxed. Then we start talking about doing the 401k side of it and getting the investments inside of it. And what do we want to put that money in? How are we going to get it to grow?
Yeah. Interesting. And is there a difference in the way that real estate investors use K versus, traditional plans? Is there any difference?
Is there a difference in how they do it? Yeah. I mean, let's say we have an entrepreneur who has no employees. Let's kind of bring that down to this scenario, because generally when we have someone who's wanting to do real estate, and the reason I say that is the IRS says whatever you offer yourself, you have to offer your employees. So if you're going to offer shares to buy into your own company, you have to offer that down to your employees as well. They are also allowed to buy shares of your company. If you want to
Okay.
buy real estate, you also have to allow them to buy real estate. So there's a lot of compliance work around that. But when you buy real estate and you want to buy, let's say you want to buy a duplex or something, or an apartment building, and you have money in your 401k, everything that has to do with that asset has to be done through your 401k. We actually open up a bank account in the name of your 401k, not your business, but your 401k. And your 401k is funding everything. I'm talking the handyman, the taxes, the insurance, the utility bills, everything has to come out of that. Okay. You cannot commingle your outside money from your own checking account or your own credit cards to pay for that. You have to do everything through the bank account. However, you are also able to get a mortgage inside of your 401k. So it's called a non-recourse loan. It's a very specific type of loan. And what you're doing basically is, let's say if you have $100,000, you want to buy a $500,000 duplex apartment building, you have $100,000, that goes into it. That's like your down payment, if you will, and the mortgage will get you the rest of it. And then you can buy the whole thing inside of your plan, but all the payments, everything has to be funded. So you need to be able to keep contributing into it or have enough liquidity inside of that plan. Don't eat up all your money to buy that real estate. You need to
Yeah.
have the flow of money coming in.
Is this something, I mean, 401k management, is this something people can DIY? Because I know a lot of people want to self-direct their 401k. Is it possible to do this on your own, or are there red flags to be careful of?
You can. There's a lot of companies out there that will allow you to do self-directed.
Yeah.
Again, it comes down to, are we doing a boilerplate design or are we doing a custom design, and how do we get the money in there? When you do the DIY approach, you as the trustee of your plan you have a lot of tasks, compliance. You have to file your FIDs. You have to make sure that you remain in compliance. You have to make sure you're doing these transactions on your own. And you can do that. If it's simple, that's fine. If you have more going on, you might want to hire somebody to help you with the compliance part of it, to help
Okay.
you. We have a really, really great tool. It's actually pretty DIY, but we do all the compliance for you. And then
Okay.
you're able to track your transactions inside of it. Meaning, what was this transaction for? Which property was this for? Was this Roth? Was it pre-tax? Was it after tax? So there's a lot that goes into it, and just making sure that you understand how to do it is important. But I think this goes for a lot of things in the finance industry in general. A huge percentage of the population can DIY a lot of it. It's once you become more profitable and more complex, then you really want to have a team around you, and not just
Mm,
us, because we're one code. We're one IRS code. There's 7,000 pages of the IRS code. So it's having a team around you to make sure that all the all these pieces are being checked. So when you're an entrepreneur, and the higher the profit, because I understand as an entrepreneur, you want to save money as much as you can,
yeah.
especially when you're in growth mode, right? It's very important to be able to do that because you got to pay your own personal bills, but you also got to make sure you're paying everyone else's bills too that you hire. So at some point, things become more complex, or you start losing money because when you're designing these things, either the taxes aren't being done right, you're not saving as much on the taxes, or you're giving too much money to your employees as well. That's a very, very common thing. So the cost of hiring a team is there, but your net is going to be higher because you're saving more on taxes, you're saving more. It's just like anything else in business. Everything in business is about the net. Are you in the black or are
Yeah.
you in the red?
Yeah.
If you're in the red,
Yeah.
you don't do
Yeah.
it. If you're in the black, you can scale that and do it all day long.
Interesting. Okay, that makes sense. And is this a, say, there's a business owner, they're using a professional. Is this a once and for all thing, or do the strategies change as the business grows?
The strategy changes as the business grows. Absolutely.
Okay.
You don't need to start with all three layers of that
Yeah.
retirement plan stack.
Yeah.
You can start with one, but you have it positioned in a way to where if you have even a one-off great year, you have it designed to a certain way where you add a stack or you add a layer to that stack
Yeah.
for 1 year or 3 years, and then you can bring it down and tailor it back and forth. Not only just starting someplace, it's having it in a position and designed a certain way to where if you have these big one-off years, then you can scale it, and you as the business owner get to keep most of the money, but also on the back end, right? On the other side of the coin is, if you have a bad year, where's that flexibility at? There's a lot of things going on with the tariffs this year, that a lot of like logistics companies, and that their revenue went down dramatically for a short period of time. And we needed to pause for a minute and be able to pause and use other assets to be able to fund it or not fund it, or just freeze the plan altogether. As long as you're able to do that, because you have a custom plan design, that's a completely different scenario, and be able to amend it and amend the plan instead of having to go with what everyone else is doing, because that one plan design is what it is. So the customization is very important, and
Yeah.
flexibility is very important.
Okay. 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 And I mean, you already started mentioning and making reference to, tax changes coming this year and into the future. The big beautiful bill. Are there any implications that that bill has on key management and design?
Actually, surprisingly, there's zero. There's no
Ah,
changes to the 401k side from the big beautiful bill. There were a few things that were originally presented that did not flow through, but I would say for business owners in general, there were a lot of changes, and I would say more on the strategy side of things.
yeah,
So because when we speak to clients, we're able to see what is available in their situation. So, like if you own a business, that's one. Do you own the building your business is in?
yeah.
Yes. Okay, so maybe this advanced depreciation option that was put in the
Mm,
bill might be also available to help you offset taxes. Again, we are one tax code. Being able to add all these different tax codes in place allow for the plan and your team to really save money on taxes for you.
interesting. Okay, that makes sense. And do you have any, I guess, personal stories, anecdotes from your work with founders and solopreneurs who have, leveraged these strategies to one, create free cash flow for the business, and then also increase the value of the business to themselves, right? Do you have any standout stories?
A lot.
Yeah.
Almost
Can you
all of
share a
them.
few?
Almost every
Yeah.
client is a standout story, I'd say. But, one right off the bat is husband-wife team. They own the business with no employees. And I mentioned earlier, everything we do is built around efficiency and efficiency ratings. So we want to know how much money is going to the owners versus the employees. And when we do that and there's no employees, it's 100% efficiency rate. So we're able to get all them money. So when we did this plan design for them, we were able to put in between the two of them, and they're around 50 years old, almost just under 600 grand into their plan total between the two of
Interesting.
them.
Wow.
And that saved them, like over 200, I think it was about 250,000 or close to it in taxes, which allowed them to invest that 250 into other investments. So they were creating investments. They weren't adding into their business. And then the other side of it is there's a dentist a couple years ago. This one stands out because they heard me on a podcast and we were talking about we wanted to get more contributions into it and how to design it. And he wanted to implement the bottom and the middle layers. So not all three stack, just the bottom two. And
Hmm.
like I said earlier, when you run numbers, are you in the red, are you in the black? And in those bottom two layers, you can get $70,000 per year into it. For him to be able to put $70,000 into it because of the way his business and his employee pool was put together, he had to give them 55,000. He put in 70, he'd have to give them 55. So
So he's
that
only
was
keeping
extremely
15.
inefficient. Yeah, very inefficient. So we said, don't do it. But I tell you what, he was a dentist. He had two locations, and I found out during our conversation that he owned two buildings, two locations. He owned both of them. So there's a strategy called cost segregation. And in the big beautiful bill, it actually has become even more advantageous.
Okay.
But you're advancing your depreciation on your business, and it
Yeah.
saved him several $100,000 in taxes. So
Yeah.
we couldn't help him, but we have our team and our specialists that we're able to introduce them to and say, hey, we can't help this person. This is the best way to do it. And it was worked out great. And the reason why it didn't work out inside of the 401k was because he was the youngest guy in the room, basically. So he was 38 years old. All his employees were in their 50s and 60s. And when you do that,
Interesting.
some of the calculations skew towards the older part of the team versus the younger. And he was the youngest person in the company. So there's nobody we
Yeah.
could target or focus on younger than him. And it just didn't work out. So that
Yeah.
happens. So you have to, every single business is different. You can't just blindly walk into it because it can hurt you after you've implemented it. We could have implemented it without running numbers in the beginning. And then all of a sudden he gets this major bill of $55,000 that he has to give to his employees. And that would have crushed his business, absolutely crushed his business. So
Yeah.
understanding how these all work out before you implement and having conversations before you implement is really, really important. Really,
Yeah.
really important.
Yeah. Yeah. And I just wanted to pull a bit on the dentist that you spoke about, and this might not directly apply to your area of expertise, but you spoke about leveraging the provision in the big beautiful bill that
Mhm.
allows for accelerated depreciation of assets to drive value for this dentist. I was wondering, when you accelerate depreciation, does it not result in like a deferred tax liability that the company will still have to meet in the future? Is the value
Absolutely. Yeah.
from, yeah, is the value, so what then is the value? Is it because you have more money right now that you can start investing today, or start investing today and make more money on in the future? Because essentially you're still going to pay the same amount to the tax authorities. You're just going to pay it later, right? Can you
Yeah, it
clarify
comes
that a
back
bit?
to it comes back to when you sell the property, right? Because it's
Mm,
all about um your capital gains tax, right? When it comes
yeah.
into this. So, and again, I'm not the specialist on this, but I know a lot about it.
Okay.
When you depreciate, it's almost the exact same mindset as pre-tax contributions. So you're saving the taxes today. You will eventually have to pay those taxes later, but you're using the tax savings today to reinvest and use that money for growth, 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 growth. If you think about when you're doing that, when you are getting pre-tax contributions. So let's do a few scenarios here. If you put 100
Yeah.
grand in, the taxes you save are called $40,000.
Mm-hmm.
That $40,000 being held by the IRS, it's a tax, it's a interest-free loan that the
Yeah.
IRS is giving you. They don't charge interest on your tax deferral.
Yeah.
The only risk there is if taxes go up later.
Exactly.
So today we're at historically lows. Where do we think we're going to go in the future? This is a question. There's a lot of politics in this too, right? It's, are we going to go higher or are we going to stay the same or go lower?
Yeah.
But it's the exact same scenario. Save your money on your taxes now so you can use it for growth. Don't use it for spending cash. Use it for growth. And
That
then
makes
you're going to
sense.
be in a much better scenario in the future.
That makes sense. So it's more like getting free capital. You invest it, you're going to pay back the same amount of tax in the future. So whatever extra revenue you can use that same money to generate in the future comes back to you. That makes a
Yes.
lot of sense. Just speaking a bit more about the on-case strategies that we discussed, is it any different for a business that's getting ready to sell? Are there different considerations for founders who are looking to sell their business in the next 2 to 5 years?
Yes. Again, yeah, it's a tool, right? Like I said, the beginning, it's the 401k should be used as a tool, not just employee benefit.
Okay.
So there's a lot to it. What you do to your plan, you can use that as part of the leverage in when you sell, too. But there's a lot of business owners who are saying they're about to leave in 5 years. They want to get more cash out of the business and into their own personal pocket as much as they can. Some businesses have value, some of them don't, right? It depends on the situation, and some have more. So a lot of times we'll do a informal business valuation to kind of see where they're at and it helps align them with what they're doing and who's going to buy their business. So step one is, let's put the stack together, the whole full stack, so the business owner can get more money out of the plan into their own personal pocket. Okay, check.
Yeah.
That's one version of it. The
Yeah.
second version is, who's going to buy your business from you? Is it your key employee that you have? Great. So let's incentivize that person and try to get the money in their pocket to help buy the business from you down the road. Let's try to get them maybe some extra bonus money. There's something called an LTIP, a long-term incentive plan, where you're
Mm,
bonusing them a little bit more money than the rest of the company because that person is going to want to buy your business and that might help them with the down payment. So you want them there because if they leave, then all of a sudden you're trying to figure out who's going to buy your business. So knowing what your business is worth and then having that bonus structure going to them, you'd rather give them some money than have to start from scratch and figure out who's going to buy your business. So
yeah.
it's a great way to position yourself, especially when you're about to leave.
Interesting. And in your opinion, what are some of the, I don't know if you call them mental or these are like just mentality mind shifts that is necessary for founders and that you found like founders and solopreneurs lacking in terms of thinking about their businesses, thinking about themselves as like the CEO of their own wealth rather than just that of their company.
Yeah, it's funny. The mass majority of the people we speak to or end up working with are probably over 40 years old. And probably even a larger percentage of that is over 50. And the reason that is because they're looking down in their business and focusing on their business alone
Yeah.
instead of taking a step back and looking at the entire picture and where does this business fit in with everything else. And the reason they do that, they're looking because this is their baby, they're growing it, and this is how they pay their bills. This is how they feed their family. And all of a sudden they look up and they're like, I have profit. I have taxes that I have to pay. And what do I do? And they're over 40 because been working for decades. And
Yeah.
then all of a sudden they're like, what do I do? Because they haven't set up anything. It's all been in their
Yeah.
business. They're
Yeah.
totally isolated in this business. And then it's all about diversification. It's all about
Yeah.
trying to expand and even possibly scale beyond that. If you think about your business as one investment, it's one.
Yeah.
It's a micro cap stock, if you will.
Yeah.
You have to
Yeah.
take care of it more than anything else, but
Yeah.
it is one, and it's just one piece of the pie, and the rest of it has to come around it. So don't just look up and when you're in your 40s and 50s. Figure out where this all fits in and where you can start. Again, start someplace. Start with the bottom layer. You don't
Yeah.
have to start with 3 layers. A lot of times we go from 0 to 100 with all 3 layers, and sometimes a fourth layer by adding these LTIPs onto the plan, which is understandable why they do that because profit. I need to keep moving. I got to keep moving, but that will help them, kind of inch by inch. Life is a cinch, yard by yard. It's awful hard. That's the kind of the saying
Yeah.
my dad always said. And I think that is every little bit counts outside of the, diversification side of it.
Yeah. Yeah. What you've just spoken about is, I believe, one side of the coin where, entrepreneurs are essentially not taking anything out of the business, just like pouring everything in, and, they haven't built anything for themselves. The other extreme is one in which, you know, business owners put everything into the business. So they have their kids who, instead of them paying their kids monthly allowance, they just make them like directors in the company and they pay them some salary. Everything goes into the company.
Yeah.
And so they're making a lot of money, but almost no profit, right? How, one, what is your opinion on that? And two, how does that affect their ability to make use of this 401k strategies?
So it's a great example of every model is different. Every business is different. I mean, we have a lot of clients who have their kids on salary. We have a lot of people who add their spouse. That's a whole nother conversation, making sure those
Yeah,
things line up and making sure IRS is happy with all that.
exactly. Yeah,
And the reason why we do that, and the reason why we sometimes even tell them saying, hey, this might be a good idea, is because they want more in their pocket. So if you have 4 employees and just you as the owner, adding your spouse will make that efficiency rating go up, or adding your kids. Now, there's a lot of tax strategy about adding your kids to your business, right? That's tax-free income up to, what is
yeah,
it, 15,000 right now. But
yeah.
there is no minimum age either to invest in a 401k. Just side note, you can be 1 years old, and as long as there's earned income in there, you can do it. Same with IRAs. It really has to do with where they're at in their journey on the company. Do they need to scale more and grow it more? Do they want to? Or are they simply saying, I'm pretty happy with the revenue that's coming in. I need to work on making it efficient for me and keeping it efficient, making it tax free as much as I can, get that
Okay,
tax cut down as much.
okay,
So I'd say no judgment there on how they do it. It's more about where are they? Like, what are they trying to do? And it's
okay.
everybody's different, and that's why these plans have to be different.
Yeah,
And your tax strategy should be different from everybody else's too.
yeah, yeah, yeah. Okay, okay. So final thoughts, Matt. If someone were to listen to this podcast, this episode, what is the one or two lessons you want them to take away?
Number one is I want to go with this is one misconception, one mistake
Okay. Yeah.
that everyone has is it's not all 401ks are created equal. It is a vast tax code. It is a lot of gray area. And when you go the DIY route, or you go to the one that is at the top of Google, or however that works, the biggest company you can find,
Yeah.
their protocol is based on their business model, and their design is based on how they want to scale. They keep it inside of a very narrow scope, and they do not think outside the box. So not all 401ks are created equal. And number two is do your research. Do your research. This is not an easy Googleable scenario, a lot of the things that we talk about today are not something you're going to be able to find very easily
Yeah.
out there on the internet, or it's you have to have conversations when you're a business owner. It's that building that team of people you can trust, and it's all about having conversations and getting the information you need in order to be able to make those decisions, and do it early. Do it early. Don't do it when there's a deadline. We haven't even talked about deadlines today. When does all this due? We're still building, as of today, it's late July.
Yeah.
We're building plans to offset taxes for 2024 still. We're still able to do that. But if you file an extension on your deadline, on your taxes, and all of a sudden September 15th comes along and you're like, I didn't get to fix any of my tax bill, it's because you didn't do the research ahead of time to figure out how to do it, or you
Yeah.
didn't, because you were stuck in your business. You have to
Yeah.
be able to look up and ask questions. When are these deadlines? And how do I have these conversations, and who can I trust?
Amazing. Amazing. I just want to thank you, Matt, for coming on the show. It was really good to have you here.
Thank you for having me. I appreciate it.
Thank you. And see you guys in another episode of the Business 101 podcast. Thank you.